Welcome back. This is the Real Money Pros. We're having a fantastic weekend. I'm Jeremiah Bates. He is Brian Wiley. We are Fiduciary Financial Advisors, broadcasting on the Real Money Pros. The beauty of this program is that we are live and you can interact with us. You can call us, you can text us. We are accessible. Phone lines are open, 979-59-MONEY. That is 979-596-6639. You can send us an email, Jeremiah, yes, the full 4 syllables, at therealmoneypros.com, Brian at therealmoneypros.com. You have questions, you want to change the topic, hey, we're here for you. Like I've said many times on this program, we are practicing fiduciary financial advisors. We see lots of complicated cases. Sometimes we see simple cases that's just, no, we just need to make a little tweak here. You know, there's an identification of this big tax savings just because we need to focus on less on the investments and more on where your money's going as far as the right account title. You want to talk about estate planning. You want to talk about investments. Big IPOs have happened recently. Some big IPOs are on the horizon as well. Some big behemoths. We're talking about a combined market capitalization value just between these 3 companies. I'm talking SpaceX, OpenAI, and Anthropic. That's projected to be close to $4 trillion. Lots of movements in the market. Obviously, we've seen some prices, some movements in the oil markets. How is that going to translate to gas prices? We had the Federal Reserve meeting where they held rates steady. The new sheriff is in town as far as the Federal Reserve, Kevin Warsh, under his leadership now. But bottom line is you have questions, and we might have some answers. So, again, call us, send us a text message, 979-596-6639.
Or spell it out, Jeremiah. How many times do people call you Jeremy? We should have bought that. Or actually, we need to get the secondary email so you can cover Jeremy at therealmoneypros.com. But it's Jeremiah.
Yeah,
or Brian.
Yeah, I think, I don't, so I'm the youngest of 3, so it's kind of like the biblical theme that my parents did. So it's Joshua, Elijah, Jeremiah. But everyone calls my oldest brother Josh. Everyone calls my middle brother Eli, not Elijah. But I stuck with Jeremiah for whatever reason. So here we are. Just make it difficult for people.
So great conundrum here. Actually found in, this is me personally too, and I know a lot of other people have the same thing. So if you had bought at the announcement of the Trump tariffs last year and you were to purchase a whole bunch of stock, especially things that were beat up at that time, you probably have a lot of appreciation in many of those stocks to the point where you may have thrown your entire portfolio out of balance. And I should say this because when I look at my own, it is completely out of balance at this point. And if you follow the Better Bucket system, the way that the Real Money Pros actually will do portfolio construction, well, then you'd say, well, gosh, I need to rebalance. If you own Micron stock like I do, it's up 1,500% from my purchase point. At roughly $70 was my average. The stock is now trading at $1,100 and some change. And so it starts to change how you start to think about things. I had a friend call me out of the blue, and he says, what do you think I ought to do? And I said, well, this is kind of the ultimate investor question, because you've either got greed working on you or fear working on you, but it's working against what that original plan was. So now if we went backward roughly 15 months, and you said, Brian, why are you putting this money into this Micron stock that, I was talking about at the air, on the air, just saying, listen, I think it's going to do well. It seems like the environment's well. And it was a guess, but it was also seemingly obvious, being that it was beat up, being guilty by association in the semiconductor industry with Taiwan and all that mixture going on. So I bought it. But now I have a lot of gains, and many of you might have the same thing, which is, what do you do about this now? So if it was in my 10-year bucket, which it is, my growth bucket, then my objective last year, 15 months ago, was to put money into something and let it stew for 10 years. But there's got to be some sensibility of when do you rebalance an account, because here's a simple fact. I had put 10% of the amount of money that I was saying, here, buy some stocks last year. I chose 10 stocks, doesn't matter which ones, and each of those 10 stocks got 10% of the amount of money that I was going to put into it. But now Microsoft actually represents more than 50% of the overall allocation because of the gains. When do you trim back? Jeremiah, you might have some perspective on this. So imagine now, fiduciary advisor, which is the only way that you work, and you're working with me in this case, and you look at my portfolio and you, Brian, like more than 50% of your account is in Micron stock. What do you do?
Well, I think you take the approach to explain why this could be an issue. And I hate to use industry jargony term, but I will in this case. It's idiosyncratic risk, and it's just a fancy way to say that, okay, even if the broader market is going up and to the right, but if something happens with that company, maybe there's a change in leadership, maybe, like, let's just look at Boeing, for instance. I mean, not apples comparison, but then we also saw this with CrowdStrike too, not too long ago, where there was that outage with all those Microsoft products, and that was strictly due to CrowdStrike, that company.
And
then you have
concentration, right?
Exactly. So, meaning you could look at these companies. I think it's just you don't want to be so optimistic on these individual companies, thinking like like your decision to go on Micron, for instance. No, that's a valid way to strategize and say, no, I think the environment's well. I think this company will do well. You made that first analysis, and then you said, okay, now where is this going to fit in my investment theme or my investment plan? Great. Long-term money fits in bucket 3, and then you follow that approach. But where I've seen this happen on the other side is where, you get these outsized gains and then you still are just so optimistic. You almost have the blinders on. Like, no, nothing can go wrong. It's in the AI space and everyone's putting money in AI and this and that. But we've seen this time and time and again where these, what you could argue are blue chip, notable companies, a curveball can get thrown and you can see a lot of those gains wiped off at the table. So this is where you enter in this idea of diversification, especially when you're looking at these stocks that are all at all-time highs where you put yourself through that practice of saying, okay, how would you feel if that stock took a tremendous drop? Let's say it fell 50%, maybe 60%. How would you feel? You're going to be like, okay, if your answer is, well, maybe it was just like this wood point in time, but I still feel confident it would come back. Okay, but I think most individuals would say that would stink. Like I would probably I'd lose sleep at night. I couldn't get over that potential loss. If you fall in that category, which I think most investors do, and again, you got to bring it back to the strategy of what was the purpose of that money? Money's a tool. How is it going to increase the quality impact of your life? Then you say, okay, let's take some cream off the top. Let's diversify. Let's cast a broader net. So when we're looking at overall market zigs and zags, you're kind of participating in that whole thing, but you're not subject to just having all your eggs in that one basket. I would start there and then really arrive at, okay, what is the purpose of this money? Then if we look at, okay, maybe taking some off, lowering that level of exposure, if that's the best thing to do, which in this case it probably is. And then we look at, are there tax ramifications on this? Now, if it's held inside of a qualified account, Roth IRA, traditional IRA, a 401k, a SEP IRA, whatever the case is, the logistical steps to do that, pretty straightforward. You sell, free up the amount of cash that you want to free up, and then once that cash is freed up, you have the landing spot for that cash to go in as an investment. Again, following the strategy of what that money's supposed to do, and then you find the best vehicles to do that. But if it's in a non-qualified account, if there's two issues that I've seen that really trip smart, savvy investors up, I'm going to say it's this. It's highly appreciated assets, whether it's a stock or rental property, whatever the case is, and they're like, hey, yeah, I get what you're saying. No arguments there. But the taxes. If I sell, I got to pay so much in taxes, and I don't want to pay more in taxes. I get it. There is a lot of strategies that you could look at that could really mitigate that potential tax hit. That's the first one. And then another one is just people sitting on too much cash, whether you got a windfall or you start to really accelerate in your earnings power, let's say like in your mid to kind of late 30s, even getting up in the 40s, and your quality of life is good and you're maxing out your 401k, maybe you're maxing out your Roth, but you still just have this extensive cash accumulation and you're like, I know I should do something with it. Year goes by. You have even more cash. I know I should do something with it. And then more time goes by. And then you just get stuck in this point where, especially where we are right now, I've heard this comment from a lot of people where, the market's at all-time highs. I'm just gonna wait to invest my cash when I see a market pullback. I've heard people say that like 3 to 4 years ago, and then you kind of get stuck in no person's land where you need to make a decision, but you're not. But to bring it back to your point, Brian, yeah, if there's one thing that's been tried and true for successful investors over the history of the market it is having a well-diversified investment approach and not putting all your eggs in one basket. Now, there are instances where people have done really well taking that approach, but there's also a lot of scenarios where that has completely decimated someone's retirement plan. So I'm a huge fan of diversification.
Well, yeah, I like the diversification as well, but then I'm also looking at the industry. So another way out of this would be to liquidate some of it and then to invest that into that industry, or to talk to a financial professional and actually look at an option strategy to try to protect those gains, which means if you have a significant downfall in the stock, you might be able to pull some of the money out of that. This is Real Money Pros.
And we're back. This is the Real Money Pros. Again, we are live. Phone lines are open, 979-59-MONEY. Send us a text message, 979-596-6639. Visit therealmoneypros.com is where you can find us. You can access our educational content, previous podcast. We did a really great podcast this past week, and I don't know when our producer, Alec, will be able to get it online, but really got educated on the whole Medicaid process. I thought I knew a little bit, and holy smokes, I did not know nearly enough. So really looking forward to get that information out on our website, because I think it's something that's top of mind for a lot of people. Whether you're getting into your no-go years, you're up in those higher years of aging, or you have parents that are in that same category, I guess. It's a conversation that comes up time over time with the clients that I'm meeting with, of how do you handle long-term care? How do you handle this cost if you have an aging parent or yourself? How to make sure that your estate isn't completely decimated. And this Medicaid program, there is a lot of misconceptions around the long-term care side of things. So just great information there. But again, therealmoneypros.com is where you can find us.
You've got issues, you can call the program at 979-59-MONEY. That's 979-596-6639. I'm Brian Wiley with Jeremiah Bates, Fiduciary Financial Advisors live program. I've got questions, some of which I don't want to ask the questions because you guys have given me some time off, so I missed the onslaught of the SpaceX conversation that you guys have probably had. I'd still like to know what people think about that. Maybe you picked up the shares on Monday. What are your thoughts about it? It's gone up. It's gone down. You had early profit taking. I can explain some of that, by the way, with the IPOs and amateur investors and the way that Elon Musk wanted to make sure that this got offered out to the general public. And now we're seeing why IPOs can be volatile because of that decision. But I've got another question, which is, I was reading an article on finance.yahoo.com, which I say it that way because if you try to put it in any other way, you will not get to the same website. The United States, according to the Swiss bank UBS, in their Global Wealth Report in 2025, has almost 24 million millionaires in the United States as of the end of 2024. Are you part of that crowd? Do you consider yourself wealthy at that point? Because I know that when I was a youngin', I'm 54 now, so I'm not. A person with $1 million was a person that was just unattainable wealth. Like, that was just a giant number. And I think that I even considered that number to be a benchmark of wealth all the way up until my late 20s. And until you start living life and really getting into what it takes to have income and then retirement income. So I've got a question. What is the number that you consider to be that unattainable wealth? I know we talk about billions, yes. Maybe that's the number. But maybe you'll compare it to your own number if you just put these numbers together in your mind, which is, what is the value of your home? Subtract the value that you owe. What is the value of your 401k? And then other significant assets, investment. Just do a round number in your own head and then call the program. Nobody knows your name. Nobody's going to know your voice. 979-59-MONEY. Just tell us the number roughly that you come up with for your own net worth, and then I'm curious what the number is after that. That is a wealthy person. What is that number?
Yeah.
You don't need to answer that one yet, Jeremiah,
no,
either, but you work with clients, and I do too, and we can see what they think is high wealth or rich.
It's all subjective. That's really what it is. It is subjective. And I forget the book that I read. This was years ago, but it stood out to me, whereas people don't want $1 million. Like, again, if we're using that number, or like 5 million. Most people don't want 5 million. They want the lifestyle that's what they think is represented by having that number, like that number of that level of wealth. So, generally human nature is, okay, if I save up to 5 million, then I can take those great vacations, I can do this, I can do that, I can retire. But, and Brian, I'm sure you've seen this too, where, we've worked with clients that have a significant amount of wealth when we're using that measuring stick of just a number. but that doesn't always translate into what one would deem as, wow, they're multi-millionaires, so they must be doing this and that. And no, a lot of times not. A lot of times there's a hesitancy to spend money, because if you're, and I get it, if you're in this delayed gratification, you're a net saver, you're getting great investment returns, it's really hard to start taking those chips off the table and say go spend it. And there's just not a lot of consideration. I know I've gone on a little different tangent here, but as I get more in this career, there just isn't much consideration on how to spend money in a way that satisfies you from like an emotional standpoint, a psychological standpoint. Most people haven't put a lot of thought in that. And if you don't, what ends up happening, again, just my experience is that there's hesitancy to pull the money out or spend it on things. So you're seeing the scoreboard can continue to go up, but you don't win at the game of life just because you have a bunch of money left over in your accounts when it's all said and done. I mean, unless you have a set strategy where you do want to leave an inheritance and like you're putting, that's a big part of your strategy. But that wealth conversation, my simple answer is it's subjective. I mean, $1 million to one person might not be enough, and $1 million, let's just say liquid, means everything to another person. The definition that I've given it for 26 years is that first dollar that nobody has designs on. Like, you don't need this dollar, and you can do whatever you want with that new dollar. That is wealth, because you've actually got excess. And somebody being rich is more of a lifestyle. It's more of a definition of how somebody appears that they're rich. And I don't really understand if there's that much of a difference between wealth and richness, other than richness seems to be kind of tainted with an attitude and how it's displayed. But wealth is actually, yes, that is when you actually have the excess. So if you talk to somebody and you say, what is the amount of money that you need in retirement? The best way to figure out whether or not you have enough for really round numbers purposes, because I remember commercials saying $1 million this benchmark number, and what it's really trying to do is show us that there is an amount of money that if you were to invest it in some way in the markets, that you should be able to live basically off of the returns of those investments without the risk of exhausting the investment itself. So you're not in a portion of your life of decumulation. And so you could say, I need $5,000 a month in retirement, let's imagine. And you could then remove the amount that you're going to get from Social Security, or you can keep it there. And then you take the $5,000, multiply times 12, that's $60,000 in a year. And you say, what amount of money should I have invested to generate that $60,000? And if you were to talk to an advisor, they'd probably say, well, based on a 4% annualized rate of return, then you'd probably need about $1.5 million to be able to do it. And so you look at all your investment money, you mush it together, and do you have $1.5 million? That's the question. If it was going to be based on the 4% annualized return, because now that's where I will probably differ from a lot of other advisors, because if you look at blended rates through a well-designed allocation, getting 4% is probably it's the rule of thumb. But it's a bad rule of thumb, because then you've got to look at client idiosyncrasies, their ability to accumulate, what's their inheritance likelihood looking like from other parents, and healthcare, the combined incomes, pensions. It gets a little bit confusing, to the point where those commercials make it sound great, but you understand that is bait on a hook to get you in front of somebody that will then complicate it in front of you to make sure that you realize that you need them. But if you need the general rule of thumb, take that number, just like I said, but still, now let's figure out what wealth is. Because wealth is when you're generating more income that you need. But what if tax planning was the differentiator, where now that number is not $1.5 million, maybe it's 1.2. Now it starts to become attainable. And what if I protected my family with the long-term care portion of it? So now it becomes even more attainable. What's your number? 979-59-MONEY. This is The Real Money Pros. We are back. This is The Real Money Pros. You go to therealmoneypros.com. You'll be able to pick up useful tools such as what Jeremiah was just talking about. Long-term care is one of the most confusing topics that I think a lot of financial advisors are either deeply into because there's a strong commission connection to it, or we avoid it because it's complicated. There are very few companies that are left participating in the long-term care insurance industry. It's been consolidated and mixed up with the generalized insurance industry to now include annuities and life insurance, and it's all over the board. And then you have this other very hard to qualify and very difficult to understand system
where Medicaid and Medicare are seemingly mixed together for many people, not really understanding the differences between the two, but there are some stark differences. And you need to learn those. Go to therealmoneypros.com. When you call the program at 979-59-MONEY, it's a live program. Jeremiah's here, I'm Brian, and we're here to help you. I've been doing this for a long time, and Jeremiah's been doing this for a long time, equally to the point where we know what we're talking about. We're trying to do this for your best interest. That is actually the topic of what I was just talking about, which is there's this weird separation that happens when somebody says you got a fiduciary responsibility to the client, which is you have a duty, Jeremiah, to then research the client, the household, and whatever recommendations you make to the client, that if you sat in front of an arbitration panel or a regulator or the client asking questions, that you feel confident enough to be able to prove that knowing what you knew at the time, that you gave them advice that was in their best interest. But lo and behold, 6 months goes by and their investments go down by 50%, and people are going to point the fingers at you. So a good advisor, obviously keeping notes and things like that, but we still will avoid topics that we're not necessarily experts in. So then you may suggest a professional to a client, and the client should then immediately have their ears perk up saying, wait a second. Who's going to be making more money now? He's now suggesting I go see this insurance guy or this tax person or this estate planning attorney or whatever it might be, that you still have to go back to that contract that you had with Jeremiah that said that Jeremiah and his recommendations were at a fiduciary level, which is a very high level of care when it comes to finances. Because it also gives Jeremiah the ability and the obligation to say, nope, I'm not doing that for you. I'm not going to make that trade for you. I don't like this particular investment for you, or greed is acting on you, so no, go find somebody else. He's actually obligated to do that. But it puts us in a weird, sensitive spot with somebody that should be leery of our industry, trying to figure out when the conflict of the advice comes in because there may be something in it for the person given it. Well, this now happens in doctors' offices, chiropractors, eye doctors. They're selling products on the way out. Their health advice now is translated to some branded product, an herb that you should be taking. And same thing with advisors. Well, there's also got to be some modicum of truth to this, because when I have friends call me up saying, hey, I got highly appreciated Micron stock, should I now divide that up and buy Tesla or whatever it is? It's like, wait a second. See, here's the problem. You don't want to actually pay for the advice, but you want the best advice. So really you want the reward with no risk, or don't want to do the work. But see, when I talked about, that number, 979-59-MONEY, that's the phone number, because we still want to hear that number that you consider to be wealth. Because I think that most people don't understand the application of the number itself. How does this apply to now finance my goal for retirement, or handle my Medicare, Medicaid, or long-term care needs and estate planning, or whatever it's going to be? That part is where you're going to start looking for an expert. And it's fine. You can get on YouTube and you can find a financial advisor that'll go through the calculations with you, and you can apply those calculations and probably come up with the right result. The question is that most people won't do it. Or they won't know that calculation method shouldn't be used for themselves because of some other situation. But are you willing to pay for wealth? That's really what it is that most people who have attained wealth have either come up with some fantastic idea that just went faster than they could actually mess it up. They had family that gave them an inheritance, or they earned so much income. But most people, and I'm guessing out of that big number that I saw on Yahoo's website that said roughly 24 million Americans have more than $1 million in their personal net worth. Most of those people do not consider themselves wealthy. Second is, most of those people, when they scrape up all those numbers together, probably still can't see how they have a net worth over $1 million. And understanding what that money means to them is, does it provide comfort? So to me, wealth in retirement is when I know that I've got enough income to handle all the basic and my wishes and all these goals that I had, and anything after that is something I don't know what to do with it. That's wealth. So for that number, let's imagine $150,000 a year is what you're living on and your working income, and you want the same lifestyle in retirement. Now use the same thing. Divide that number by 0.04, and you're going to come up with a number that's going to feel like, whoa, I can't do that. But then you go sit down with a guy like Jeremiah and you lean on this contract that says he's a fiduciary, and he says you need to go sit down with, let's say, the CPA, because we're going to save you some money in taxes, and we're going to reduce that number because maybe the $150,000 is not what you need. But Jeremiah suspects that it's more like 120, but he wants to verify it with the CPA that's going to charge you, let's say, $500 or $1,000 to now switch over and do your taxes. And yep, there was something in it for him. And Jeremiah was like, yep, because I'm acting as a fiduciary and I'm going to make sure this client's going to stay. Most people will not actually pay for this advice. That's a fact. They will go, they'll lean on, some news articles. Maybe they found it on Yahoo or on Google or whatever it's going to be, or a couple of YouTube things, and they get burned out and they don't do it. We're paid to make sure that it's actually done, to include making sure that beneficiaries and titles are set up right. So when it comes to funding these goals, they actually happen. So answering that question about what should I do with the Micron stock that now represents more than 50% of that particular portfolio of mine, the answer is I need to go to see somebody that has my back, listen to their perspective, translate that into my goal plan, and then see what I should do. The fact is I understand my own portfolio enough that I have to give that stock more time, even when it goes down, but I'm going to do some sensible things in it that advice I would have given myself as a client, saying, well, we're going to put together a put-call strategy to protect it. Both on the upside and the downside, we'll earn some income on these calls. We're going to have some downside protection, but liquidating doesn't really fit the 10-year long-term bucket that we entered 15 months ago, and you just have outsized gains in it. We need to move through this and not let greed or fear act upon it. 97959 money. My answer to that one about the number that seems like wealth to me, personally, it's that $10 million mark. That is the number where I honestly just don't know what else I would need to do or want to do with it. That would pass all my business development ideas of things that I wanted to try out. That number is a big number. It's giant. But it's also the number I said feels almost unattainable. That's okay. That's my wealth number. What's yours? 97959 money. Because there's a lot of things that are competing for our interest right now in this world. Like what are the results of this Iran war? What do you feel about that? And then we can get people riled up about it. But then you still won't answer the question about what is the wealth one. Because we don't get that personal with ourselves, but we'll certainly get personal into these headlines and have opinions about it, and we'll point fingers and all these things. Because what I've noticed is that I get a lot of advice from friends who tell me, oh, Brian, you should do this, you should do that. And I actually had it just a couple days ago, and I actually kind of lit up a friend. I apologize. I said, it's kind of funny how I get criticized for the decisions I make by people who have not made great decisions themselves. I'm like, your life is not together enough for me to actually digest what it is that you're saying to me in this case. And it took him back a little bit, but on the other hand, it was something he needed to hear, and I also needed to say it, which is, come on. I'm actually trying to follow the plan, and you're criticizing it. Last year, if I would have followed this particular person's advice, I would have followed his advice to go into a very toxic cryptocurrency that I didn't last year, but I was looking at it with signs and signals, looking like, man, this one looks pretty scammy. Turns out he's lost all of his money in it, and it was very scammy, and he's not getting it back. And meanwhile, I was looking at tried and true ways last year. When he was giving me that advice, I said, why wouldn't you buy these great American companies that are being beat up by guilty by association, reliant upon this tariff deal that President Trump is trying to put together, that we know that the conclusion of it, they're going to come up. Here we are again presented this year with another opportunity with this war in Iran, knowing that there are companies that are being beat up, that the conclusion of the war will actually probably help these companies recover. So we're given these opportunities of resets. And here we are with one right now. And another big opportunity then goes last weekend, SpaceX. Did you have the money for the IPO? Well, not if it's at risk of your portfolio. You don't do it. You wait till next year's opportunity. But they do keep coming every year. And that FOMO, that feeling of missing out on something, works against you to the point where maybe you don't even address your portfolio or answer that basic question, which is, when is it wealth? For me, 97959 money. Now, Jeremiah, we've got to talk about the rest of the world. I want to talk about what's gone on with the investment world. I've been watching these numbers, feeling like Man, this is rinse and repeat. I've seen this so many times in my career. There is so much opportunity out there, but how are you feeling about it? Are you seeking the opportunity? Need some ideas? Call the program, 979-59-MONEY. This is
Businesses today face a barrage.
Welcome back to the Real Money Pros. Again, we are live, 979-59-MONEY. That is the phone line. You can also send us a text message, 979-596-6639. TheRealMoneyPros.com is where you can find us. I'm Jeremiah Bates. He's Brian Wiley. If you want to change the topic, you got questions around our opening, what's the word? But it's like when we start the show, there's a line that's said where
monologue.
We want to make the complex or confusing money strategies simple, and a lot of times it is the simple answer. Sometimes there is an overcomplication of things, and we're not here to do that. We're here to guide. We're not here to sell. Sponsor-driven program. So again, give us a call. What do you have top of mind? 979-596-6639.
Baffle them with, I can't figure it. I can't say it. Not allowed to. But that was actually a principle that was taught in a financial advisor class when I first started in the industry. They said, they didn't use those terms. They used the term, they said, well, you need to enlighten your clients and give them the education, but if you give them all the education, they become do-it-yourself, and then you're going to lose a client. And I thought this, I'm like, wait a second. So basically you're telling us to keep them deliberately confused so I can control them to keep them as a client. Like, this does not match the fiduciary contract I'd be signing with the client, which is if the client wants to learn this, it's in their best interest to learn it, because the direct relationship of learning about how to invest is that you will become in control of your emotions. You'll be able to understand how to identify them and then control them. The biggest issue with all of this stuff, as I started the program and I think we'll end it in this hour, is that emotions drive bad decisions for investors. And the fact is that if you are a strategic investor, that you are more likely to make it. This article that I'm reading says, according to the U.S. Census Bureau, their data says 1 in 5 households with a white householder had a net worth of at least $1 million. Doesn't matter. For households with a black householder, the ratio falls to 1 in 20. It does matter. I get it, but it doesn't for this one, which is it's still possible for every household to have it. Yeah, maybe some groups are less likely, and I'm sorry for that, and that's an opinion for a different show. But the fact is that we have a lot of millionaires, but that does not make you wealthy. It might mean that you can survive on the income. But as I was telling the friend the other day, and I said, this is why I was asking you a year ago, I said, what is the number that you need to feel secure with? And I said, you couldn't come up with it. You're giving me 4 million, 8 million, but you didn't have a reason for it because you didn't know what it meant to translate that into something useful in your life. And that's what I'm saying. You've got to translate that to how is it going to provide income? If it's a retirement question, then it's got to be related to the income question. And then how do you get that number? Well, easy one is come up with the amount of income on a monthly basis, multiply it times 12, and then divide that number times the expected rate of return that you know you can get from an investment year over time. So be conservative. Use a number like 0.06 or 0.05 or even maybe as high as 0.07, and that should give you a ballpark number to generate that amount of income that you'd put into that calculation. That's a start. But then you start throwing tax savings in here and you say, well, if you fund up an HSA, it could save you $2,500 a year in federal taxes, which will apply that into additional contributions to your 401k. Well, then that translates into more tax savings. Then we're going to maybe put some into a Roth on your spouse's behalf and so on and so forth. The tax savings may lower that number by a generous amount. So then it alleviates that FOMO. I'm missing out. I'm not being able to make it to this goal. I don't need to buy SpaceX. I don't need to worry about the risk of a Tesla stock, but maybe now a company that pays a dividend like Procter & Gamble or Ford looks more attractive. Well, if that's the case, then we've reduced the risk in the portfolio by simply reviewing it, noticing simple things like tax opportunities, missed opportunities. Those things then translate into a lower expected rate of return, which then Boy, if you can actually invest this money and generate those returns without a complete significant risk of messing the whole thing up, then you're calmer, cooler, and a better family person all the way around. That is the value of good fiduciary advice that is not conflicted with commissions or additional things that they could pick up to make more money. But alas, one more thing. Let's imagine that fiduciary, like Jeremiah, said, you know what, your tax accountant's no good. We need somebody we can communicate with on a regular basis behind the scenes without having you being involved every time, without them charging us for every 6 minutes or 10 minutes that we're on the phone, but instead get this advice to them. And the fact is that Jeremiah or any good advisor is going to be so well trained to understand and identify tax misses that it's effective and efficient advice that even if he were to receive something back, which, by the way, would have to be disclosed. Oh, yeah, your $1,000 a year of your tax preparation, I'm going to get $200 back for that. Well, maybe that's okay in that case, as long as it's disclosed and the result is better than you or better for you and it's proven back to you, well, then you do it. Because if you want wealth, you've got to follow the instructions for the pathway to wealth. There is a method that works for most people to get there, and it actually involves a strategy. And if you don't have the strategy on a piece of paper, then you're like me. Because I'm downstairs in the garage building stuff, design build, and you know how much wood I have to recut to refit the stuff it fit perfectly in my head until I actually got it down there. And then I started noticing I could have been a lot more efficient by just having the plan.
Well, that's it. I mean, I don't think it needs to be overly complicated. Yeah, there's some nuance around the vehicles that you use to get to that desired outcome, whether it's a stock, a bond, a fund, maybe it's a alternative investment. You're looking at the private markets. Maybe it's, the list goes on. But when you distill this down to just the foundation of your decision making, it is that. And I've said this before, that good financial decisions don't happen by accident. You could argue that's the exact same thing on the flip side. Bad financial decisions don't happen by accident, because you could go through, analyze that of, okay, made this decision, didn't really have a good strategy in place. Like maybe in hindsight 2020, when you go back and look at it, yeah, it was greed. Meaning I thought this was going to give me turn into $1 into $1 million. I think that recent crypto phase or crypto mania that we saw, I think got a lot of people's minds turning on that. And you've seen people take some big outsized risks that they had no business doing in the first place. But if you asked them, well, what was the strategy? Like, what was the plan? Even if that plan did hit, like, let's imagine that did actually come into fruition, and it's like, okay, that happened, but what was your goal as far as the outcome? And a lot of times those types of approach doesn't even have that defined versus the strategy, the incremental steps to get that, and a plan that has been tested, or parts of that plan that have been tested and shown that it's worked previously through different market scenarios. And then you bring it all back together of, you can't look at these decisions in a vacuum on its own. I mean, that's too short-sighted in my opinion. You got to look at the whole picture, and that's where, we had a caller call in last week, and it was like really around like, what's the planning? Like if someone were to hire a financial advisor for a plan, like what actually comes from that? Like what's involved in that? And it's a good question, because a lot of times that can seem a bit vague because it's not something tangible. But I would argue that's exactly what it is. It's looking at every moving part of where you've been, where you're at right now, what we anticipate to happen down the line. What are your resources that you have right now? How can we project those out based on adjustments that we're going to make to ultimately arrive at what you've defined as your desired outcome? And that desired outcome might change. It's like financial planning or retirement planning a lot of times is a line drawn in the sand, right? It's not concrete. If you draw it in concrete, your life might change a year from now. It's like, okay, now we got to completely unwind that plan. That thing needs to live and breathe and be somewhat portable, but you can also factor that into the plan too. Of like, man, I'm really worried about this, or I got this child that's doing this and I really want to support them there. Great. Let's see how we can pivot things around so you understand the plan, you understand the strategies, you're well educated on the various routes that you can take to get there. And then you make that decision, and then you follow it. And then no matter what's happening with the markets, with SpaceX, with Iran, man, you feel good and you can sleep easy at night and continue to do the things that are important to you. It's usually revolved around family and those positive things that are in life that we all enjoy.
So you want to get the value out of your portfolio, your financial decisions. You need a little bit of help. You can call the program at 979-59-MONEY. And the help doesn't stop there. Go to therealmoneypros.com. We'll connect you to the best advisors, those who will sign a fiduciary relationship with you. This is The Real Money Pros. Stay with us. And we are back for the second hour of The Real Money Pros, therealmoneypros.com. If you're looking for a live financial program on the weekends, you found it. Jeremiah Bates is here. I'm Brian Wiley. Both of us seasoned financial advisors, still active in practice, still understand the fiduciary world, the advisory world, taxes, estate planning, all of that. Now, you talk about opportunity. And so some people will say, it's rental properties. It's going to be buying real estate, or is it competing things like crypto, or should I be buying stocks? And, of course, you could listen to the last hour and figure that out. But then you've got to ask questions. You can go to therealmoneypros.com, use the Ask the Experts feature on the front page, or send us an individual email, Jeremiah at therealmoneypros.com, Brian at therealmoneypros.com. But the bottom line is we get questions. So this hour, we're going to focus on those. So we'll read the question. And, of course, if you were to email one to us, if you sent us specific data, we're not going to repeat that on the air. We're going to certainly change it enough to make sure that we get the general point out to the rest of the listeners, because some of these need to be known by more than just the person who sent the email. We want to teach you the why. TheRealMoneyPros.com, 979-59-MONEY. That's 979-596-6639. You can listen to us on podcast. Catch us on YouTube just as well. So if you want to see the video feed, you can do that. Jeremiah.
Text lines are open, like we said, right? And this topic, it's timely. And I think this is a topic or a question that is going to accelerate, in my opinion, over the next 5 to 10 years. And again, phone lines are open, or the text line is open, 979-59-MONEY. That's 979-596-6639. Okay, we got a text question that came in. My wife and I own 3 rental properties. They're worth quite a bit more than when we bought them. We're getting tired of being landlords. Is deferring taxes really worth it? We'd like to use our money to enjoy life, but the taxes scare us a little bit.
Taxes on the sale of the property, if they were going to liquidate the income.
Yeah.
Okay, so in our industry, and you know this as well, is that we have been, if you were to listen to this program, you would accuse us as being the guys that promote the use of the stock market. And, of course, we would steer people away from real estate because it would have nothing to do with our business, and it's actually not true. So what Jeremiah was saying in the last hour about diversification, it's a good thing. But let's do it with a plan, because rental properties fit squarely into our middle round bucket, square peg, round bucket. It's a great item to put inside that income bucket, because real estate, if you do it right, you will invest money into it and you'll figure out a way to generate an ongoing regular income from it. Not only is it potentially great income, but it could also translate into really tax efficient types of income. So secondly is then we have the community property or the separate property, however you want to look at it, but we have step up in basis that will happen at liquidation when you sell these properties. And if you've lived in some of these properties, then you've got some tax rules that could apply that could benefit you. So the answer is, when applied really well, real estate can be one of the best ways to generate retirement income because of its regular income. However, even though people will own rental properties like this, they'll look at it and say they're highly appreciated. If they looked at their Zillow report 3, 4, or even 5 years ago, they may have noticed that they came down in price and then it's gone up, and they get nervous. And right now, they're probably looking at a great price thinking, let's liquidate. That's fine. So now the question is being asked, and what do you do about it? Jeremiah, how do you really answer that question for somebody you don't know them?
We got to make some assumptions here. Now, let's assume, okay, I'm going to give a two-pronged answer to this. Let's assume that they're not relying on these rental properties for cash flow, like retirement income, meaning the net income that they're actually deriving from these rental properties. Maybe they're supplementing their income from other places. So like that. And again, to be clear, I'm talking about the economical impact, because I do think that there is rentals are looked at through like rose-colored lenses sometimes. And I did this for a client a couple weeks ago. We looked through the past 5 years of the performance of their rental property, and the the performance as far as its cap ratio, meaning like the income that they were receiving was, I think it came out to like 3%. Like it was pretty low, meaning that return on that investment when it was all said and done by the vacancies, the cost, the maintenance, like it just wasn't that great a producer. And on top of that, add in the headache of the maintenance and all that of being a landlord, of being a rental property owner. So I would look at that first, see, okay, what do we have? And then when you look at the tax options, like if you're worried about the taxes on selling a rental property, maybe the answer is rip the Band-Aid off and pay the gains. But if you're really worried about that, there's a number of options that we can explore to help keep more money in your pocket from that potential sale, and to include all the stuff that you mentioned, Brian. But again, we're going to go to the phone lines right now, 979-59-MONEY. That's 979-596-6639. We have Mark calling out of Long Beach, California. Mark, what can we do for you?
Well, I was interested in the way you were talking about how much you need to not wealthy but being rich or whatever. So I've got my house. I've always wanted to own my house. My house is worth $1.5 million. Now, I haven't had any payment for like about 15 years. I have no bills. My cars are paid for, and my house expenses, generally with taxes and insurance, and without gas or groceries, is probably about $12,000. I've got about $700,000 in the bank, which I'm doing T-bills on, which I'm getting, let's just say, $25,000 a year. So $25,000 a year, and I'm getting about $40,000 with my wife and I, just Social Security. She has no other income, so we only have cash that we're investing, which I got out of the market a while during COVID. So basically, I'm probably spending about $20,000 a year, maybe $25,000 a year off of my principal, the money that I have to invest. I'm excluding my house equity because we want to live in the house and maybe give it to our daughter. So, I was in the market and I got scared. I'm 75 years old and I really don't want to lose any. And 2008, I was lucky enough, and the other 2000, to sell everything. And I didn't take that 30% hit. And then, obviously, I got back in the market. But I've been out of the market. I missed the COVID thing. I got completely out, and I didn't have any upside, but the market continued to go up. So I lost all that appreciation, which would have been great to have now.
But why? Like, why would that be great? Because you're only at a burn rate of $20,000 a year on a $700,000 account that should last 35 years at that rate. It doesn't sound like you're too worried about it because you took your emotions out of the market, and you're effectively going through a distribution plan, leaving your equity in your home alone. It sounds like your wife is well taken care of. You sound calm. It doesn't sound like it, even though I don't love T-bills, especially if it's inside of a qualified plan because you're not getting the tax benefits of it. But if you're not worried about it, there's probably not much you really need to change unless you really want to maximize it for inheritance or see a boost in that disposable income.
Well, the thing about it is, I don't know what's going to happen down the road as far as health. Maybe if I live to be 95. Yeah. And I'm worried about, so if I deplete that money, obviously I can always, do a reverse mortgage. I won't be destitute. But the last thing I really want to do is use that money out of my equity, which, it's a saving point, and my kids didn't do the right thing, But I would obviously want to leave the house and stuff to them without touching that. So,
your kids, if they're good kids, which I assume they are, they're going to want to watch you and your wife live the greatest life that they can, and whatever is left over at the end of it is exactly why we have inheritance. So I would, even though you may have that desire, it sounds to me like you just need to have the conversation to let you know that what you're doing sounds like it's probably a pretty good path for you.
Yeah, I've been struggling with, I started, because I always have been in index funds, Vanguard, many years ago, and when I was younger and still working, I put everything I could into my savings. I didn't want to work. I was able to retire kind of early, but I'm into the market a teeny bit. But boy, when that fluctuations comes up and down like that, and I just don't feel that I can risk losing $20,000 or $30,000, right? I mean, in 10 years, I don't know that.
And what I'm trying to get at is that let's remove that word "feel" and let's make it more appropriate because it's part of the plan. And that's the conversation I'm suggesting you have. Because what if you even paid somebody $200 for an hour to feel better about your decisions?
We are back. This is the Real Money Pros. Phone lines are open 979-59-MONEY. That's 979-596-6639. You can send us a text message as well. Mark, we certainly appreciate the call. And Brian, you and I were chatting during the break that, I mean, you look at Mark's situation. I mean, he's sitting on a $1.5 million house that he and his spouse live in, own it free and clear, no other debt. Expenses are relatively low. He's 75. I'd imagine his wife is probably close in age, so maybe they're both early 70s. Combined Social Security income of $40,000, and they have $700,000 of investments inside of T-bills. And just a quick note, if you hear the term T-bills, just think of Treasury bills, debt issued by the United States government. So you have what's called T-bills, T-notes, and T-bonds. And the difference between these is the length of time in which they mature. So T-notes are your shortest maturities. So think of that as not as subject to the volatility that is in the bond market, depending on where like interest rates are going or where concerns of inflation were going. Where if you look at the 10-year Treasury yield or even the 20-year Treasury bond, those things are going to fluctuate a little bit more in price. So just wanted to let that know. Basically, it's an approach to be pretty conservative. I mean, really conservative, while getting some level of tax efficiencies on the interest or coupon payments that you're getting off of those bonds.
Which is why I wanted to continue the conversation with Mark. And Mark, if you want to call the program back, you're welcome to do so. And if anybody else has questions or wants to expand on this topic, please do. 979-59-MONEY. But let's talk about the T-bills themselves. So one of the benefits of buying the world's safest security, which is the debt that is issued by the United States, and with all of its authority and tax collecting abilities, it will repay it. It's got a great history of doing so. Well, that in exchange is now going to become tax-free income. So just think of it as getting the money market account from your bank without the 1099 that you're going to have to pay taxes on that little amount that you made. So the T-bills are really about preserving the capital that is inside of an account. So we would put this right into the very first buckets of the Better Bucket system that we use with the Real Money Pros, and you can learn more at therealmoneypros.com. But that first bucket is about capital preservation, not about income. So when he talks about a burn rate of $20,000 a year, we're really looking at that whole $700,000 sitting in the first bucket when, in fact, some of that $20,000 is needed beyond 3 years from now. So you could say, well, we'd be a lot more efficient putting $60,000 into the first bucket that would be invested in the T-bills and not collecting any sort or causing any sort of taxable event. But anything beyond the 3 years could be looked at to be put into the income bucket. And by the way, it could be very conservative investments, could be using a mixture of stocks and bonds, or it could be all bonds, could be municipal bonds. But then we got to look at the account wrapper. What type of an account do these investments potentially sit in? If it's an IRA, we definitely don't want to lean toward the Treasury notes and bills as the only safe way to invest the money, because we're not picking up the secondary benefit, which is the tax benefits of it, because we're already in a tax-deferred type of an account wrapper. And so these little efficiencies then start to dissolve fear. When you start to explain how, well, in that account, let's do this, and this account, let's do that, and just knowing. So many times it's just the confirmation. So maybe Mark's plan is great, and a good financial advisor would agree with him that his path is good. And so Mark has got this question, which is, am I doing the right thing? I pulled out of the market during COVID, and now I'm here. And the answer to this one is there's probably a lot of fine-tunes that can be done. Now, is it necessary? I don't know. Mark sounds fairly peaceful. He sounds a bit fearful from the markets themselves, and he had said it, which was, Well, we just don't know what the future is. And so my reaction and how I felt was how I ended up in this portfolio, which means let's not do it by feel. Let's do it by design. Let's do it because the numbers work, the risk fits. The fact is that they have goals, and let's identify those goals, and then let's also look at the fact that they live in the state of California. So you got Prop 13 that works for you if you're going to sell that property and transfer it and fit within all the weird rules and the way that they've modified Prop 13 to fit. But there may be a secondary chance for Mark and his wife to be able to then sell the house at some point and move to another place that better fits their needs. Or you just leave that equity in that house until the very last minute, because he could be solving or actually adding a component to fit with the plan to help with an unexpected, very expensive long-term care situation for either of them, which, in California would involve Medi-Cal planning. And that's where you need a fiduciary that says, all right, now I'm going to send you to the vultures because we're going to need to actually have a Medi-Cal type of a plan, or how we're going to handle their version of Medicaid if there was a long-term care situation that's necessary. Mark, you're so close to being able to feel really peaceful about this, and if you want a connection to a great advisor, we'd love to be able to provide that. Call us back. We'll get your number. We'll set you up with the right advisor, and it might be somebody on our team. That's it. 979-59-MONEY. That's 979-596-6639.
Yeah, not much more to add to that. I think you pretty much well covered it. But I do find it interesting when he talked about COVID, where it sounds like Mark was invested. I mean, he said that he was invested up until the 2007-2008 crash, and then he sounds like he may have timed it somewhat okay, where he didn't ride it down to 30%, and then he got back into the market, and then COVID hit, and then I'm assuming that he sold it during recognizing those losses. But he made that comment after he said that if I would have stayed in, it would have been a lot better. Like, it'd be a lot better right now. And he's absolutely right. 100% if he would have stayed invested. But I would argue that there's a combination of this where for Mark, hindsight's always 20/20. But if you had that strategy or that plan going into COVID, then you would have known that your liquidity needs are already met. And then, your growth bucket of money, or the amount that's invested, we know that's going to be at the mercy of the market, and we all saw what happened after that. It was like a wound rubber band. So I think there's a part of Mark's success. Well, Brian, I agree with you that he seems calm. It seems like his money's serving him in a great way right now based on his spending and where they're at in ages. But for some people, they don't have that breakdown, and that market, that growth side of their money is needed to hit these tangible marks.
If you've got a situation you want to bring it to us as well, just a quick look, then we're happy to do that. 979-59-MONEY, and some of it needs to be done off air. That's fine. Go to therealmoneypros.com and ask for the help. We're here to help you. The conundrum that he is in is actually one of those things where you can look back at it. And here's a fact. 2026, you and I were actually really enjoying this time with our clients because it also helped us as advisors with an opportunity to change our clients from what was providing income in their income portfolios to recognize the discounts that the market was presenting to us and allow us to move our clients and change out the income sources to dividend-paying stocks that had long histories of continuing dividends, which, by the way, you can find lists like that online. Do you look up Dividend Aristocrats? It's a great list. And it is a list of companies, American companies, that exist in the S&P 500 that have continued to pay their dividends and raise them or not lowered them. And that criteria alone starts to make exclusivity, because you have some companies like GE that stop their dividend, or Boeing. Well, they fall off that list. Some of them have now been on that list for 5 decades. And so if you say, how can I provide myself with reliable income while staying invested? Because remember, an income stock is doing 2 things. One is you're getting the yield, which is the dividend payment that comes to you. And your yield is either going to be calculated based on what you put into the stock. We are back. This is The Real Money Pros, therealmoneypros.com. I beat you to it, Jeremiah.
Caught you with a mouth.
Well, I went out a little bit early on the last one. Well, that, and I didn't hear the time cues getting out.
That's the beauty of live radio.
Yeah. We're talking about that. Well, yeah, and we're talking about that income piece of it, and I was talking about dividend aristocrats, and these are really simple things that a good do-it-yourself investor can start to research, and you can actually get this done. So go back to Mark's call. Mark is asking, could I be getting a better yield? And the answer is absolutely. The question is will you actually do it? Because when you're in something like that and you see COVID come around and you're sensitive to the values of it, it really comes down to the understanding of the purpose of each bucket. Because let's talk about reading that statement of that middle income bucket, let's say during COVID, and you had a stock that was paying some income, you felt pretty good about it, and the stock was at $50 a share, and you're getting your, let's say you're getting $3 a year out of it, so you had a $6 or 6% yield according to the market value of the stock, and you felt pretty good about it, and all of a sudden it goes down to $25 because of COVID. And so now your account value goes from $500,000 down to $250,000, and you're looking at it going, oh my gosh, I just lost half the money. But then you get your dividend payment comes in, and you still got that same $3 for each share that you had, and you add that up and you've got the same income, and the next month your account value is still low, but you got the income. Now, if you as an investor could say, wow, I kept getting the income, then we would say, then why are you worried about the underlying value of the liquidation value of the stock? That is like talking about Elon Musk's net worth right now. He's over $1 trillion. I get it. It's great for news headlines, but if he brought all those stocks to the market, he wouldn't be worth nearly $1 trillion, because he also throw in the presumption that he's leaving industry together, so everything he does is out. He probably wouldn't have a net worth of a paltry $100 billion or $250 billion or whatever it's going to be, but it's not going to be that. And it's the same thing with your income portfolio. You need to look at it, is the income reliable still? Is it still sufficient for my needs? Do these investments still show that they have the ability to pay for this type of income? So we go back to rental properties, which is the first text question we had in this hour, which is this good? Well, yeah, if you look at it for the purpose of the rental property. When you bought into it, you probably thought, well, we want the rental income. If you're still getting it and it serves those needs, then the answer is it's probably still okay. But if you're looking at it saying, I want a capital appreciation out of it, and you look at it and it's got great gains, then yeah, you got to take the gains when you hit those marks of your goals. Otherwise, everything else after that is fear or greed, usually driven by some sort of lack of understanding of the actual topic or how it fits that specific application to the person.
No, it's well said. I mean, and
that's my feel on rental properties are great if they're generating income. Otherwise, they can be a real pain when you got to go fix a toilet. When you then compare it to a stock that's paying 6% as a dividend, and you look at your yield to market on the rental property, and you're thinking, I'm fixing a toilet, and I would never have to do that if I just owned that stock. I don't even have to show up to the shareholder meetings. It just gets credited to the account, and yeah, it can be easier. So we can sound like stock guys sometimes because we're also looking at how the clients are holding their investments and using them.
Well, then
real estate may not be the best thing for everybody.
May not, but it also could be good. But you also just look at the functionality of the rental property when you purchased it. You had cash. You then purchased an asset in the form of a piece of real estate that, again, is subject to it going up or down in value. But you have tenants inside of that rental property. And as long as they're making good on the payments that you listed out in that lease agreement, you are getting cash flow. Now, you also got to understand that there's expenses that are tied to the said rental properties, where if tenant calls you, there's a tree down, there's this, there's that. Not to also, I mean, I don't want to poo-poo on rental properties. I just want to give, everything's a T-chart in life. There are pros and cons. There's trade-offs with everything. So with the rental property, it's like, yes, you have this tangible asset that you can go and see. It's real estate. But then again, when you have the tenants in there, you also have the liability. You have the liability of this, where I've had multiple clients over the past couple of years that are going through some litigation type items because the tenant felt that they were at fault and they were not upholding their landlordy duties. And that's another aspect of this too, where again, rental properties just can't be looked at through rose-colored glasses. But let's just assume that in this case, they own highly appreciated rental properties. It sounds like they want to unwind it, but the thing that they're hesitant on is the tax bogey on that. First and foremost, understand what the tax bogey will be. I've had conversations with a couple people where they said, no, my CPA said not to sell it because all my money is going to go to taxes. I'm like, whoa. Okay, I get it. Like, you would owe some taxes, but you're not, all the net profits are not going to go towards taxes. Like, let's find out for sure what that number is going to be. Sometimes the solution is rip the tax Band-Aid off. I'm a huge advocate for being tax efficient, implementing tax strategies, but that juice has got to be worth the squeeze. I've said it before, tax tail can only wag the dog so much. And sometimes this elaborate, complex tax planning, the best answer is just rip the tax Band-Aid off, but be prepared. Understand, plan for it. Understand what that tax amount's going to be so you have the liquidity to cover it. So it's not just shooting from the hip. And then when you file your tax return for the year that you did that sale, it's like, oh my gosh, we owe this much. No, you want to know that in preparation of selling said rental property. But let's imagine you do want to defer taxes, 1031 exchanges. Let's imagine you're a bit of a dog or a pain of a butt rental property. In this case, they could take the gains from all three rental properties, 1031 that, exchange that into a single property. You got the 121 exemption. Maybe they're okay with selling their primary residence and then moving into one of those rental properties, and they mark it as their primary residence for 2 out of the past 5 years. Well, then you can sell that property, and you're married filing jointly. $500,000 of those gains are not taxable, meaning you could probably sell that rental property not paying any taxable gains. That has a little bit more quality of life impact because it doesn't make sense to move from primary residence to rental property. Who's to say? You have Delaware Statutory Trusts. If you just want completely passive income and defer those gains into a Delaware Statutory Trust, that is a great idea as well. You also got opportunity zones. Meaning there's a long list of tax planning that you can do that gives you the best of both worlds. Get rid of the headache, the tenants, the toilets, and the taxes of that rental property, and then you're still recognizing some level of income, or you're getting that capital event, meaning you can do a mixture of both. It's not just black and white when it comes to selling this rental property, but bottom line is you need a plan. You gotta look at what's the foundation of this, what are the implications of plan A, B, C, and D, and maybe the proper answer to that is a combination of all of them. But just don't sit idly and think that the taxes are the only reason why you shouldn't sell a rental property that's a bit of a headache for you.
So, Jeremiah, you are bringing up something that in our career we see this a lot of times. And if you were to identify, and this goes back into the last hour's conversation, a client that you would define as having wealth, would you agree that most of them also have some sort of additional real estate in their portfolio that is outside of their personal residence? Yeah. It's a part of it, right? It is. And so if in the best way that I've explained, the reason why you want to keep rental properties sometimes, and especially in a married situation, is because you're going to take advantage of the step-up in basis that happens on the first death. In a married situation, a lot of people don't really understand this. But here's a fact. If you own something and you're married and you had bought it, let's say a house at $100,000, you've lived in it for 40 years, and then at the time of death, one of them passed away and the other one says it's time to leave. Well, they're worried about it because the house is now worth $1 million. They had only paid $100,000 for it years and years ago. What they didn't know is, one is all the improvements that they made with the home that actually are going to stay with the home are likely going to be part of that cost basis. So they might be able to move it up to, let's say, $150,000. So now you got an $850,000 gain. If they were to sell the house, you would think that they're going to be subject to gains on the taxes. But now there's a step up in basis. So the death happened. The spouse remaining then sells the house at, let's say, $1 million, owes no money in taxes, zero, because they have this step up in the value of the property if it were sold after the first death. This is the benefit of being married, or the benefit of actually inheriting an asset from somebody, which is this step up in basis. So that gets planned into it. You got the 1031 exchange that you just mentioned, Jeremiah, and you may remember a client of mine. This is a long time ago when you and I were still just working in the beginning together. She had a large real estate portfolio. Her husband had passed away, and she really had no interest whatsoever in trying to maintain them. She had nothing but bad things to say about it, and the renters themselves. And I said, well, why don't you just sell them? She goes, well, I can't. He's had these forever. And I said, no, now's the time to do it. So we got the kids in there. found out that they had lived in one of the houses within the 5-year mark. So I said, well, there may be some reasons to keep on to some if you wanted to move into that one and so on, and we could look at all this stuff together. In the end, she had to come to terms with the fact that she was now the manager of the household income and the inheritance for the kids. She had an opportunity to look at these things for step-up in basis, and half of the property she sold. She invested the money. She set up her kids for the inheritance, fixed up her estate planning, and it worked out for them. But are you doing the same thing? 979-59-MONEY. This is the Real Money Pros.
Welcome back. This is the Real Money Pros. Again, we are live. Phone lines are open, 979-59-MONEY. That is 979-596-6639. You can call us, send us a text message, send us an email. Jeremiah at therealmoneypros.com. Brian at therealmoneypros.com. We are fiduciary financial advisors here for you. And if there's one thing, listen, we talk through complex topics, if you want to call them that. We try to make them not complex, but the reality is good financial decisions do not happen by accident. You're navigating retirement, taxes, business decisions. If you're looking for more clarity around your financial future, having the right guidance matters. If you want to get connected with a fiduciary advisor who can help, visit therealmoneypros.com, click Find an Advisor tab, and we will get you connected with an Apollon Wealth Management fiduciary advisor who is a good fit for your situation. Brian, on this topic of rental properties, I mean, I know you own some rentals, or maybe a rental back in the day. But those are the issues that come with it. And obviously there's the financial decision, there's the emotional decision, there's the diversification decision. Because I'll be the first one to say, yes, when you look at the benefit of rental property, it could be a great cash flowing producing investment. You can still have that long-term capital appreciation on that property, which is great. And then the tax efficiencies on it are certainly there. I mean, when you look at your actual tax return, how that rental income actually flows to you, there's a difference between the net rental income that actually provides an economic impact for you in your household. Fancy way to say, hey, that's money you can spend, right? But that net number, you get your gross rents, you have all your expenses, that's money that's available to you. But that net number is usually not what's actually going to be taxed at your federal and state level. You also have what's called that depreciation side. So when you talk about these tax efficiencies, when you talk about the step up in basis, and then you talk about, again, not to sound redundant, tax efficiencies, if you want to unwind a rental property, you can certainly do that. And this 1031 exchange, just real quick to clarify that, essentially you just roll those gains from that investment into either another property, or there's other type of investments where those gains just go into that new asset or that new investment, and you don't pay taxes on them in that year that you got out of that rental property. But here's the cool thing about 1031 exchanges. You can have some tax deferral and hold back some liquidity. The rules with 1031 exchanges is you have to roll your basis first, like meaning the amount of money that you purchase. Let's just use a rental property, for example. That has to roll through the 1031 exchange, the basis first. So let's just say it's $200,000 and you sold the rental property for $500,000. That $200,000 has to go through the 1031 exchange. But that $300,000 gain, which otherwise would be subject to capital gains tax, that you can be a little bit more nuanced with. You could hold back all of that gain. You could hold back some of that gain. Of course, you're going to pay taxes on it. But I've a couple clients that we've done some 1031 exchanges. They like the idea of deferring the taxes out, not running into that taxable event, but they also wanted some liquidity. They're like, we're sitting on huge gains this rental property. It would certainly be nice to maybe hold back some cash so we can do some fun things in retirement. Completely agree with that. Let's solve for what makes sense as far as recognizing that taxable gain. And let's still operate the 1031 exchange. Make sure it's smooth. Make sure it's easy. It's all above board. Your hands never touch the money. It goes through a qualified intermediary. There's some rules that you have to be very mindful of when it comes to 1031 exchanges. Just to be clear, we've talked about this on previous shows. Go to therealmoneypros.com. You can get that information. But bottom line is, these strategies might seem like, there's so many moving parts, and it sounds like something can get messed up. Why do we need to get that complicated? As long as you have someone who's experienced, who's in your corner, hopefully working as a fiduciary for you, these things generally can go really smooth. And if you're worried about the liquidity side of things, through those 1031s, you can certainly hold some liquidity back. But that question that we got through the text line, it's great. I mean, like I said, I think we're going to see a lot more of this over the next 5 to 10 years, where people are going to be sitting on huge gains of these solid investments that they got into at the right time, and now they want to start unwinding these things. And in my opinion, that's kind of a natural progression in retirement, where you want to simplify things. You don't want a lot of moving parts, but you also want to capture the liquidity, but also be mindful of the taxes. Again, realmoneypros.com is where you can find us. Go ahead, Brian.
Oh, no, that sounds good. Thanks. I was going to say that there's so like last year, for example, when you had the market fall, President Trump had announced the tariffs. We had mentioned that, you might want to look at a time. This is a great time to look at the allocation inside your investment portfolio. So let's say that you had rolled upon a company like Ford, and you're like, wow, I've got all these rental properties and I'm tired of fixing toilets and things like that. And you go through the tax questions. Let's say you rip the Band-Aid off of it and you said, I'm going to go out there and I'm going to look and see what is competing with this. So back in like March or April of last year in 2025, Ford was trading somewhere in the $7 to $9 range. Now it's trading at roughly $14. It says it pays a dividend of 60 cents per year. Well, they have not changed their dividend for a number of years. So that means last year when it was at $9, if it's paying 60 cents, it's got a pretty decent yield if it's trading at $7. And wow, you're saying a 9, close to 10% annualized yield. You bought the stock. You're happy with the income. Here's the stock now at $14. So you have that gain sitting there, but you don't take it because it's still providing the income. But the nice thing is you're not fixing a toilet. You're not looking at an application. You're not paying a rental agent, meaning there's also got to be the maintenance of the investment itself matched to the investor, which, maybe your real estate was getting you a little bit more, but it's stressing you out a little bit. So you should look at something that's just going to fit your lifestyle a little bit better. And the fact is that people buy dividend-paying stocks because they're also looking for long-term capital appreciation. Here's something I did personally, and I blew it, which is last year when I put my money where my mouth was, and I had said, here's my list of American companies. We had said it here on the air, was I didn't go through each one of the ones that were paying dividends and sign up for dividend reinvestment. I had intended to. I forgot about it. I did it just the other day, and that is the DRIP program or whatever DRP, whatever you see that. If you're interested in having that done, you got to make sure that you tell your custodian that you want them to take the dividends and convert that to more shares of the company so you can pile up the dividends, because if it's meant for income, generate more income. That's the answer. The phone lines are open, 979-59-MONEY. That's 979-596-6639. If you miss or can't get in on this hour, then you can call in the next hour. If your radio station doesn't pick up that next hour, you can pick us up at therealmoneypros.com or search for us on your podcasting app.
Yeah, the conversation about this comparison of real estate versus, say, the markets, it'll continue on. I mean, some people, they just love the real estate side of things, and there's others that don't necessarily have a desire to enter in the real estate space. I'll be the first one to say that many clients that I work with that have done extremely well with rental properties, what I find is they usually own you could argue a portfolio, usually about 3 or more, where I find that they really have these things flowing. They have a process, like they kind of they manage these things like business operators, like they're operating these things. Generally speaking, when there's just that one single family property, it's you. And again, I'm painting with broad brushstrokes. So,
this matches to me. Yep.
Yeah,
but to me.
A lot of times you fall victim to the tenants where they're like, yeah, I should be charging more, but I'm not. I'm like, oh, okay, well, then we're.
Oh, I did it.
It's kind of a charity case than necessarily strictly an investment lens, which is fine. But those are, real estate is not the end all be all, but there's some pros to it, certainly, but you just got to look it through it. You got to be detached and analytical about it.
I don't know if you remember this or not, but in the late 90s, probably in the first part of the decade of the new millennium, there was a lot of television commercials of guys that were promoting their real estate investing system, and then this dog and pony show of them going around the nation and people paying a lot of money to go to the seminars. And usually part of that would be to discredit anything having to do with stock markets or insurance or whatever it's going to be, and the answer is all real estate. And then you find this annuity guy doing a radio program talking about the stock market as like if it's a casino, and the answer is all annuities. And then you got these stock guys, Jeremiah and Brian, and you're thinking they're all stock. It's not the case. There is a stark difference between that type of advice of what is in it for the person giving the advice. Well, for us on the Real Money Pros, it's our advertisers. We appreciate the advertisers. We present advertisers to you that we believe will do most of our clients or listeners great. And that's it. We're working as fiduciaries. We're giving good advice, and we're here and available for you. Go to therealmoneypros.com. Find us there. Jeremiah Bates, I'm